Hey guys, it's Jennings. Listen, I wanted to talk to you guys today about the number one thing that is going to protect you and your syndications and your investors from the next recession. The next recession is going to happen. We're going to have a pullback. And how can you prevent that from hurting you, your investors, your reputation, your investments? Like, what can we do about that? So I'm going to talk about this right now, break it down. There's a little bit of math involved, but I promise it's going to be worth it. Check this out. Okay. Right here, we have a chart. All right, you got 100. That's our baseline. All right. 150, 200, 250, 300, 350, 400. And think of those as like multiples. So 200 is like twice of 100. Okay, you got it. Down here, we got the years. 1982, starting here, 1990. 2000, 2010, 2020. So I pulled this data from the Fed, St. Louis Fed. I'm probably going to post the links to these charts so that you can see them for yourself and research them. So the first thing I'm going to go over is the multifamily housing price index. Okay, so right here, 1984, $50,000 million worth of stuff was spent or purchased in 1984. Okay? In 1990, it was 60 million. 2000, 100 million, and this is per year. 2008, look at that spike. This is where, times are good. We're getting into the early 2000s. Everything is going crazy. 180 million. It's really billion. But then, boom, recession, down. 120. So now we're hitting, almost 2000 levels. Then goes back up, a little correction, and there was a little correction here too. And then right now, boom, look at this, 300. So this is 2020, and this is where we started 40 years ago. And you can see, it's massive spike, big pull down here, and now we're way up here. Okay, so that is pretty good chart. If you were going to make an investment in something, it's like, hey, that's fairly good. But what if you had bought right here, and what if you needed to refinance right here, and what if you needed to pay back your investors right here? How do you protect yourself from buying in this swath of years? Because what if we're here? Like, what if in 2025 we're going to be in a trough? Like, how do you know what's coming up? Because it kind of looks like something's coming, maybe. I don't know. I don't have a crystal ball. But I don't want to be the guy buying multifamily right there and pitching my investors and telling them I can get them great returns, and then boom, So how do we protect against that? Next is CPI, the rent of primary residences in the United States. Okay, so that's what this chart is. Right here, 1982. 0 or 100. Okay, so let's just say this was $1,000 a month in 1982 for a apartment. It probably wasn't that high, but let's just say it was. All right, so in 1990, we're at 125, so a rent would be $1,250 a month. You're following the math here? We're going to 2000. Rent is looks like about $2,000 a month. Okay, we're going to 2008. 2007, 8. We're hitting the recession. It's going up. It's going up. It's going up. We're at maybe 250, 260, and then boom. Well, no, not boom, because look at this. It goes straight across. And when I saw this, I could not believe this chart. This chart really reinforced the way that we buy, and I was like, I got to talk to this about people. This is really, really important because it can protect you from losing a ton of money. Okay, 2007, 8, we're at 260. 2010, we're at 260. So what does that mean? That means rents were $2,600 a month in this example. All through that period, they stayed $2,600 a month. So rents did not increase, but rents did not fall. I saw this person with my dad's rental properties. In 2006, 7, I was just getting out of college. My dad had a rental portfolio of about 15 homes. His rents didn't go down at all. Now his net worth on paper, they were single family homes, but plummeted. I mean, maybe cut in half. But his income every month stayed the same. Okay, now, here we go. Rents, boom. They kind of overcome this little lull, and now they are at 360. Is the actual data. So a house that rented for $1,000 a month in 1982 is now renting for $3,600 a month in 2020. Okay, so look at this. Look at this line. The holy grail of investing is predictability. This is what creates risk-adjusted returns. When you have something that you can fairly reliably count on is going to trend up or down, but you know you do not want this whipsawing action when you're trying to make an investment, because who knows if you're buying at the top. And sometimes, you're going to do well. Sometimes, most of the time in multifamily, you did well. But the stakes are really, really high. So if you could hedge against that, why wouldn't you? How could you? And so I think the most important metric, the number one metric when you are analyzing an apartment deal, whether that's as an investor looking to get into a syndication, whether you're buying this on your own, whether you are a syndicator and you're trying to figure out what I should buy and how much I should pay for it, is the rent, okay? So you've heard of the 1% rule, maybe. You've heard of the 1% rule. 1% rule, if you haven't heard of it, is if I can buy a unit all in, remodeled, everything for $100,000, and I can rent it for 1% of $100,000 per month, what is that? That's $1,000, right? If I can hit that 1% metric, I'll be okay. I'll break even. I'm not going to lose money. Maybe you don't make a lot of money, but that's kind of like old school single family rental math. And in the Charleston market, it's pretty hard to find a deal that meets that 1% metric. In multifamily, the metric that I like to use is 1.5. Sometimes we're even getting 2%. So that means if we're buying a unit for $50,000, because an apartment unit is cheaper than a single family home, if we can rent that for 1.5% of $50,000, which is what? $750, right? If we can get that per month, that's not all we need to look at, but that's a good baseline starting point to say, okay, this deal has some meat on the bone. This deal will cash flow. It is based off of an extremely durable number, because this number, historically, over the last 40 years that we've been measuring this number accurately, has not whipsawed and moved up and down in any significant fashion. And so if you're in 2020 and you're basing your analysis off of what are the rents in my market today, not what I project them to be 10 years from now if I can raise them 2% a year, but what are they today? If your deal works with what rents are today in your market, then you're probably pretty safe, because even if we hit something massive, and nobody knows the future, of course, disclaimer, horrible things can happen that nobody is expecting, but in a very terrible economic time, rent stayed flat. And the guys that were betting on their rents at this point, that they didn't have to get the rents to go up higher to make a profit, they were fine. And in a few years, now they're really in the black. And so that's where I think that this is such a durable and important metric, that if you can get $750 to $1,000 for a unit that you're all into for 50 grand, you're going to be great. Now, I know there's a lot of people out there that are thinking, hey, that's awesome, that's great. I can't find deals like that. That's true. They are not easy to find. I wouldn't say you can't find them, but they are not easy to find. And a lot of times you got to buy something that has a problem. It's run down, it's been mismanaged, it needs renovation, it needs updates. We're looking at a property right now. They're renting studios for $375. They're renting one bedrooms for $425, and they're renting two bedrooms for $550. The market rents are $750 for ones, $850 for twos, and $500, $550 for studios. However, we're not going to get that with the condition that the building's in. Like, we've got to re-roof, we've got to redo the siding, exterior paint, carpet, countertops, granite, paint. We got to work. We got to make this property better. But if we can, we're buying it for $35,000 a door. Let's say we have to put $15,000 per door into it. So we're all in for $50K. But if we can get $750, that deal is going to cash flow. That deal is going to work. I mean, there's a lot of other metrics you have to look at after that. And I'm not saying make your decision just off of the percentage rule. That would be extremely foolish. But if you are making decisions off of this, which is how a lot of guys do it, they call it a cap rate, or appreciation, or hey, there's a product selling, it's $110,000 a door, Jennings. You want to invest in it? My first question was, well, what is your market analysis for the rent? What do you think you can get for the rent? Well, we think we can get, $1,200. Okay, I mean, that's a pretty decent market rent. But then when you look at that, okay, yeah, you're meeting the 1% rule, but that's about it. It's not hitting my 1.5% metric. And so I'm thinking and saying, hey, that's kind of an expensive price for that property. I don't think that would work for me. Oh, no, because the other properties in the area are trading at a 5.5 cap rate, and they're getting $130,000 to $140,000 per door for very similar properties. You know what? Could be a good investment. It really, really, really could be. And if you were buying right here and you were selling right here, you're going to make money and you're not going to be exposed. And everyone's going to think you're a genius. But if you're buying right here, thinking it's going to go to here, and it goes to here, you're not so smart anymore, are you? And so this is the metric that matters. CPI, rent of primary residences in the United States. This is the durable metric. This is the durable metric that you need to base your purchase price off of, and all your underwriting needs to start there. All right, guys, I hope this is helpful. I filmed this kind of myself, so the videography may not be the best, but have a great week, great weekend. See you guys. Bye.